Alright, time to hit one of the biggest areas of Chapter 5. And that, of course, is our retirement accounts. Now, there are plenty of retirement accounts out there. We're going to look at the two principal ones that are here in the U.S. One is known as the Traditional IRA, which the annual contributions are deductible. Retirement distributions are taxable, and earnings are not taxable in the current year, only when you actually do the distributions. Then you have the Roth IRA. Okay, annual contributions are not deductible. Okay, retirement distributions are non-taxable. Okay, earnings are non-taxable in the current year. Again, it's a distribution thing. But it all works out. More people are going to Roth than the traditional. Even though you have that big one that traditional is deductible and Roth is not. So, how can we do these? Well, there is certain limitations that we have. Now, Roth or traditional IRA contributions is limited to either lesser of 100% of the taxpayer's earned income or $6,000. $12,000 if additional $6,000 is contributed to IRA of spouse that has no earned income. That's one caveat to it, but it's basically $6,000. Okay, maximum contributions to spouse's IRA again is $6,000. That's why we got the $12,000. And good old-fashioned 2020, because things have gone crazy in 2020. Taxpayers and spouses age 50 and over can actually contribute an additional $1,000 in our classic annual catch-up contribution, increasing the contribution to $7,000. So there's your limit, basically $6,000. And if your 100% earned income is less than $6,000, that's where basically you can't do the full $6,000, but most likely we'll have to see. Alright, so annual deductions maximum are reduced for traditional IRAs if taxpayers participate in another qualified retirement plan. Again, basically to separate out throughout each of the retirement plans. For Roth IRAs are reduced for all taxpayers over certain income levels, but is not affected by taxpayers' participation in another qualified plan. Again, so you're looking at traditional, it's affected by qualified retirement plans. Roth is not. It is affected by income levels. Okay? In each case, though, maximum annual contributions is phased out proportionally between certain AGI ranges. Okay? So, if taxpayer contributes to both traditional and Roth IRAs, combined contributions cannot exceed that $6,000. $7,000 if 50 or older for 2020. Taxpayers with income over the phase-out ranges may contribute to non-deductible traditional IRAs. They can still contribute, but there's some that we just cannot take. So, example. Because I'm guarantee y'all need examples for these guys. They can be fun. Anyway, we have Noah. He is age 42, so we don't have to worry about that 2020 thing for the 50 and older. Is single and wants to contribute the maximum to his Roth IRA. His IHEI is $126,000, thus his contribution will be limited. Okay. Using the 2020 AGI phase-out ranges for Roth IRA contribution table. Calculate how much Noah can contribute to his Roth IRA. What amount could he contribute if he was age 62? Alright. So how do we figure out these contribution limits? Alright. So I already have a little bit of trouble with this PowerPoint because they didn't really go and hit those ranges. So let's go ahead. Before I go over that, let's go to the IRS website. And we're going to go and search for Roth IRAs. Okay. And let's see if we can look here. And here's our table for 2020. Okay. So single, we have this reduced amount. Okay, so if we fall between the range of 124,000 and 139,000, we do have a reduced amount. And if we had income over 139,000, we get zero, nothing. Okay. Again, it's always good. I just like using the IRS website, honestly, over trying to find it in the book real quick. But it is in the book. Alright. Ooh. PowerPoint. Alright, so this is where they get the 139,000. So, for us, we get 139,000 minus 126,000. And then you see they use 15,000 here. Divide by 15,000. That's the range of this. The 124,000 to 139,000. That's the range. Okay? That's how we figure out phase outs. Basically, we're figuring out the percentage. Okay? Back to the PowerPoint. And we're going to go from current slide. Alright. So, 139,000 minus 126,000, which is basically like 13,000, divided by 15,000, and then times by 6 grand, which will come out to 5,200. I'm actually going to go ahead and show you this on the calculator. So we had 139,000 minus 126, and you divide that by 15,000 for that range. So roughly we get to do 86%, 87. So times that by our good old-fashioned 6,000, and that's where we get the 5,200. Again, we have to figure out the limit. Alright, so the same thing will happen for age 62. Now it's not a full 1,000. Remember that also. So even though we can contribute an extra 1,000, we're still hit with the limit. So again, I'll just take that, and we're going to times it by 7,000. Still the same range, and this is where they get the 6,067. Usually we round by whole dollar amounts, basically to the next whole dollar amount as we go. But basically that's what's going on. It's the limits, so if you need help with the limits, you can find it in your book under this section for IRAs, or you can check the IRS website. As you saw, I found it very quick. So again, married, basically we'll have a limit between 196,000 and 206. Again, the range looks like it's 10,000 on that one, so it's a little bit different. Married and filed separate, basically if you go over 10 grand, you get nothing. Yeah. So I wouldn't do a married, filed, and separate and try and do a Roth. You just won't get any. Okay. Fun stuff. Alright. So, traditional IRA. Let's look at this. So we have Liza, I think it's Liza, and Mikhail. Sometimes the names I just cannot pronounce. Hopefully I do. But I guess, it's just how it is. Anyway, they're married and are both 41 years old. They file their taxes jointly. Liza is covered by a 401k plan at work and earns $96,000. Mikhail is not covered by a plan at work and earns $30,000. Okay. Again, we have a phase-out ranges for deductible traditional IRAs table. So let's go see if we can look at those. So back to the IRS website, and we're going to look up traditional IRAs. So, traditional IRAs. And let's see. You don't really have too much of a table right here. So it looks like we're going to have to look at one of these publications. Okay, so for 2020, if you're covered by a retirement plan at work, your deductions for contributions of traditional IRAs is reduced / phased out if your modified AGI falls under this. Okay, so we're looking at 104,000 but less than 124,000 for a married couple filed jointly. Okay, more than 65 but less than 75,000. So there's 10,000 there. This is 20k and less than 10,000. Again, yeah. All right. So there's our limits. Not an actual table as the Roth, but we found them. So let's look at PowerPoint back up. Now, looks like we do hit the phase out range. Why? Is that the total spouse is 126,000. And we just saw that could be falling into that limitation. So if you're covered by a retirement plan at work and you aren't, and you live with a spouse and filed a joint, your deduction is phased out not fives more than 196,000, but less than 206. Interesting. Lots and lots of interesting facts. So, here's our limit. And they put both of them, but I like looking up on the IRS site. Okay. So, when one spouse is active in a retirement plan and the other is not, two separate income limitations apply. Okay? The active participation spouse may take a full deductibility IRA contribution unless the 104,000 to 124,000 phase out range applies. Okay? The spouse who is not an active participant may make a full deductible IRA contribution unless the higher 196,000 to 2006 phase out range applies to the couple's income. So, what happens here? Well, for Liza and Mikhail's joint income is 126,000, which we calculated. Now, since it exceeds our phased out range, it's above 124,000. Liza cannot make a deductible contribution because she already participates in the 401k plan. Okay? However, since their joint income does not exceed the 196,000 to 206,000 range, Mikhail can make the full $6,000 of his traditional IRA contribution. So, no give and take. Watch out on the limits if they're participating in another retirement plan. Whew. That's not it. That's far from it, because guess what retirement plans can also do? They can convert. So, Roth plans with IRA conversions. So if if a taxpayer wishes to convert a traditional IRA to Roth IRA, including those with many years to retirement, a low current tax bracket, high expected tax bracket in retirement, that's maybe why they convert, negative taxable income. Okay, so there's many ways that they want to convert. That's up to them. By no means is a tax accountant a financial planner, unless we actually went and got that degree. But, if you want to suggest, you can always suggest. It's not bad. Just remember that you are held liable if something bad happens. Anyway, income generated by the conversion is subject to current income tax. Okay? Simple as that. You made money. Conversion is subject to that tax. But there is no longer a rule that taxpayer must have $100,000 or less in AGI to convert traditional IRAs and Roths as they've been in years prior. They got rid of the rule, so everybody can do it. And then there was much rejoicing. Yay. Alright. So distributions. Welcome to the penalties. Alright. So, money taken from traditional IRAs is taxable as ordinary income and may be subjected to 10% early withdrawal penalty if taken before age 59 and a half. Okay? This is a big deal. Okay? People can get hurt very quickly if they don't do the 10%. This is why we also have you tell them to withhold federal income tax to cover yourself. But we do have some exceptions. And these exceptions include if you're disabled, using a special level payment option, using the withdrawals for unreimbursed medical expenses in excess of the 7.5% of AGI, Recipients of at least 12 weeks of unemployment compensation, and paying medical insurance premiums for their dependents. So that's an and. Gotta watch out. Paying higher education costs, tuition, fees, rooms and boards, etc. Purchasing a home for the first time, you get about 10 grand there. Beneficiaries due to death of an IRA owner. Again, the form will actually tell us. Withdrawing funds due to an IRS levy. And a qualified reservist. Yeah. Okay. Then the CARES Act comes in, and it extends the 10% penalty tax exemption to distributions of up to $100,000 made on or after March 27, 2020, and before December 31st, 2020. I believe this actually did get extended a little bit more, but we're going to keep it here, December 31st. A taxpayer or a spouse or dependent diagnosed with COVID-19 using a CDC-approved test, or to a taxpayer that experienced adverse financial consequences as a result of quarantine. Okay. So, two special rules do apply. Taxpayer may include the income ratably over a 3-year period starting in 2020, and amounts recontribute to qualified retirement plan within 3 years can be treated as a rollover, and thus the original distribution would not be subject to tax. That again is to deal with COVID-19. Okay. No RMDs are required in 2020 for taxpayers who have reached age 70 and a half. And that's required minimum distribution. Okay. Now, for taxpayers younger than 70 and a half, required minimum distribution begins by April of the year after they turn 72. Okay. For IRAs, there is a requirement, and that depends on the IRA, that you really do have to take a distribution. Alright, Roth IRAs. That's a weird voice. Anyway, their distributions, withdrawals are tax-free as long as Roth IRA was open for 5 years, and any of the following requirements are met. Okay, so you gotta have at least 5 years, and the distributions are made after you've turned 59 and a half. Beneficiary are after participation's death. Participant becomes disabled, and distribution is used to pay for a qualified first-time home buyer's expense, again up to that 10 grand. Distributions may be taxable if any of the requirements are not satisfied. The part of the distributions that represent a return of capital is tax-free. However, if there's a part that represents a payout, which is basically interest or any additional money that was earned in the Roth IRA, that is considered taxable. Okay, fun stuff. I will actually show you which form that we look for. So, here, 1099-R. This is the typical one of distributions of retirement. Let me go and pop up the instructions. See if both of these pop up. There we go. Alright, so like I said, as many times as you can, try to pull the instructions for each form. You'd be surprised what you can learn, especially in the Roth's news section. So, 1099-Rs. This is typically what we look for retirement accounts, pensions, and other items. And this will have all the information we need, but it will also tell us the gross distribution that came in, and also taxable amount. Again, this is for Roths. It may be different, could be different for a traditional. It will also tell us if the tax amount is not determined, then it's on the whole gross. And if it's the total distribution, means that they have nothing left. There's our federal withhold and our employee contributions designated for Roth. Then it's this code here. Okay, this code right here is very important for 1099-Rs. That's why I want to put up the instructions. So let's go find the codes. They always have so much going on. Okay, there we go. There's our boxes. Federal income tax withholding. And then here's our distribution codes coming up. Alright, so here's our codes that you would see. Now, early distribution is typically one that we see for, which is code 1, and that's when you did not reach age 59 and a half. Okay, code 2 with only exceptions, and again they will tell us which exceptions are usually there, but there's a conversion, distribution made from a qualified retirement plan, all sorts of things. 3 is disability. 4 is death. Okay. 5, prohibited transaction. Okay. And 6 is a Section 1035 exchange, which we're not getting into. That's a little bit above our pay grade right now. But most commonly, you'll probably either see 4 for a death, or 1 for an early distribution. Okay, and 1 is the one that we want to watch out for, because that's probably going to have the 10% penalty attached. So always be wary of the codes. It's always good to know them. Here's 7, 8 more codes. So 7, normal distribution. 8, excess contributions. 9, cost of current life insurance. Maybe it's available for a 10-year tax option. Sometimes you do see 2 codes together. I may see a 1A, 1B, designated Roth, payable death benefits, D, annuity, E, distribution under employee plans, 5, charitable, G, direct rollover, H, direct rollover designed from Roth, J is an early distribution from Roth, K is distribution from traditional IRA, C, more codes, we got L, loans, M is qualified plan loan offset, N is recharacterization, P is excess, Q, qualified distribution from Roth, R is recharacterization, S is early distribution from a simple IRA, T is a Roth IRA distribution with exceptions, no exceptions. U is dividends under a ESOP under section 404K. And then finally, W is charges or payments for purchases of qualified long-term care. Again, if you want to look at these, you can. More power to you. It's always good to know all the codes. Okay, just want to show y'all that. Back to all little PowerPoint, we have a knowledge check. So which of these are features of an IRA, traditional IRA? Is it A, annual contributions are deductible? B, annual contributions are not deductible? C, retirement distributions are taxable? D, retirement distributions are non-taxable? E, earnings are taxable in the current year? F, are not taxable in the current year? Okay, pause, see which ones you know that are features. Okay. So the following features are it. If you choose A, C, and F, you are good. Remember, contributions are deductible, distributions are taxable, and earnings are not taxable in the current year. Okay? So that concludes the fun part of retirement accounts, of going through them. We're still not done yet, but we're going to close out this one for individuals. We're going to go look at basically business, small business, and self-employed in the next part.